Pension funds remain one of the largest pools of investable capital in Nigeria's financial system, and incremental adjustments to asset allocation limits can significantly influence capital market liquidity and price discovery. Now, to shed more light on what PENCOM is saying and market implications is a fellow of the Chartered Institute of Stockbrokers of Nigeria and currently the General Manager and Chief Investment Officer NLPC Pension, Modai Ekundayo Stephen, who joins us virtually from Lagos. You're welcome to Business Express.
Good afternoon. How are you?
I'm good. I believe you're good as well.
Yes,
okay.
Lovely. Thank you.
Well, let's delve into it. What specific evidence and objectives underpin PENCOM's decision to raise allowable ordinary share limits, and how does the addendum address the identified shortfall in qualifying alternative assets?
Fantastic. Yes, I think this is a welcome development from the regulator, PENCOM. You and I know that if you have who's just 2 or 3 years old and is trying to go to school, you put him across the road to get to school. But when the child is 20 years old, you have to take some risks, allow the child to go to school himself. Ditto for the pension assets. Initially, when we started, the major focus is safety here and there. But now the asset has grown to a level that we have to take some calculated risk. And I think that's what PENCOM has done. Yes, in the last regulation, reverse regulation of pension investment of pension fund assets, there are new introduction of asset classes, but some of these asset classes, for example, alternative assets, you have LFC qualifying assets that a pension fund can invest in. So it is a welcome development that PENCOM decided to increase the allocation for equity to enable all those allocations that cannot be invested to be invested in the market and to enhance the return of the RSA holders, and it also deepen the market. I think, to me, PENCOM has done the right thing, and it is what is expected at this point in time.
Now, how will higher equity caps now change the risk-return profile of each RSA fund type, and what are the expected implications for contributors at different stages?
There are different fund types, from 1, 2, 3, 4, 5, 6, even 7, and the newly introduced one, that is foreign contribution, foreign currency contributions. So in Fund 1, the allocation initially was 30%, but we see that most of the PFAs have even gotten to this limit. And we see that because of price appreciation, PFAs have to do what we call haircut to bring the asset to that within the limit. And this resulted from PFAs selling some of assets that should have been retained just to keep themselves compliance with the PENCOM limit that has been given. So I think it's not necessary if there are good assets that have been sold because of regulatory limit. I think that's the reason why PENCOM decided to increase this limit so that we can retain for long term all those assets in the portfolio. For example, Fund 1 increased from 30 to 35. Fund 2, 25% was the cap before, increased to 33. Fund 3, it was 10%, increased to 15%. And Fund 6 active from 25% to 33%. And what we are going to see is that pension fund is a patient fund. It's going to trickle down the market. You see activities in the market, and you see it leads to price discovery. Even for the PFA themselves, you will see that there will be enhanced performance in terms of return. If you look at last year, the equity market returned over 51%. And when we are looking for assets that you can that have, if you adjust for inflation, that should give you real return, is the equity market. In 2024, the market returned over 30%. In 2025, over 51%. Then what are you saying? That is a welcome development by any standard. And I think the assets we are managing will benefit from this increase.
Okay, let's talk about the risk. What risk management safeguards will PENCOM and fund managers apply to somehow mitigate greater equity exposure?
All these we have its own associated risk. Sincerely speaking, increased exposure to equity will increase volatility, especially in the portfolio. Yes, there will be concentration risk because there are some stock that the PFAs like to buy, either a particular stock or a particular sector. There will be concentration in that sector, and you can see overpricing of some of these stock or overvaluation of some of these stocks. And you see potential reduction in the fixed income. Fixed income has given us the safety net that is flying to safety, but now we are flying to equity because of return. So you can see those are the risks we are going to see. But notwithstanding, if you have a long-term horizon for equity, it is the best asset class to invest in.
Now, how
and
might
the safeguard we have.
Okay, go on. Go on.
You talk about this safeguard. Yes, we have this asset allocation, and that we do on a yearly basis. That each of these asset classes we have what to allocate to each of the asset classes. That's a form of diversification. So when you diversify your portfolio, you find out that some of these, where some are bad, some will be good, and they will ease out. So we have internal controls and committee too that look at what the PFA does on a daily basis.
Okay.
Yes, the internal control will look at what. Yes.
Okay. Now, you said the internal control will look at.
Yes, what the investment department does on a daily basis. Maybe they go over the asset limit, or they are investing in the asset classes they should not invest in. So they are there to monitor those areas. And also, there's the balancing every time. When we see that we are above those limits, we do what we call haircut. We can rebalance the portfolio every time to ensure that we bring ourselves within those limits. So all those mitigating strategies, we reduce those risks.
Now, how might
and above all, let me say this, above all, if you have long-time horizon with the market, it overshadows, it covers all those short-term variation you see in the market. Over a long period, I think the equity market will neutralize all those short-term variations that we call risk that we embedded.
Now, how might the change affect Nigeria's domestic capital markets, and what controls are in place to somehow prevent market distortion or conflicts of interest? You just mentioned there may be concentration in one particular equity.
Okay. So from this increase, we are expecting about 1 trillion to trickle down the equity markets if those limits are fully utilized. And I tell you, there will be more activity in the market, there will be price discovery, and there will be liquidity in the equity market. We are even talking about going the $1 trillion economy. If you want to get to $1 trillion economy, the equity market is the way to go. Companies can come to the market and borrow and raise capital.
Okay, actually, this one is for the investor now. I mean, the retirement, the retiree. How will higher equity exposure now change expected retirement outcomes, for different age cohorts?
For those who can take risk, Fund 1, Fund 2, those are Fund 6 active, those are where those element. And I think it is necessary for them to be able to get higher return in that area. But for the retirees, I think we'll do more of fusing already benefiting pension. We don't want to subject such people to volatility in the market.
Okay, but for pensioners, you said, is it a matter of choice? You decide to, maybe invest a certain percentage of your retirement savings?
No, the regulator says that from the maximum you can see a good equity is the maximum is 5%. Those one has not been increased, and because of their low risk appetite, that's why there's limits so are left there. You see, we have other assets that we can invest in that can already benefiting pension. So they are not ready to wait. They want, you can't tell them that, okay, the market has dipped, and because of that, you are supposed to get 50,000 and you can't get 40,000. It's going to be tough. Such people, you don't or you give them 50,000 tomorrow and say, okay, no, the next tomorrow is going to be 45,000. No, you don't subject retiree to such relation. That's why the quantity of equity there is so low, 5%.
So the markets now benefit from these huge funds.
What I'm saying is that, we have different risk profile for these funds. Fund one are those people who can still take more risk. Young guys below age 50.
Okay.
Ditto for fund two. But fund three, you have 50 and above. So the higher you are, the less the risk you are able to take. So for where the bulk of the money is in fund two, fund three, the percentage of equity has been increased in those funds, including fund one. But those who are going to take less risk, or who can accumulate less risk, who are not ready to take more risk, are the retirees. Okay. Those are the ones who allocated 5% of equity to their fund.
Okay, okay. I think that's much clearer. So now, what are the likely short-term and long-term volatility impacts on RSA fund values, and how will this affect near retirees?
Okay. If you look at the market now, today, even year to date, it has returned about 17% in 2026 alone. You can see for those RSA that have higher allocation, the return will be there. But the type of asset we want to give to the retirees are those ones that are stable, where the returns are more stable, fixed income, and you can see for now, the fixed income is still very attractive. You can get 16%, 17%. Yes. Then with 5% allocation to equity for the retiree, I think it's okay for them. We should not subject them to too much volatility.
Okay, before I let you go, are there communication or liability risk if contributors experience larger losses during market downturns?
When there is market downturn, I think what PFA should know now is that they should have mitigating factors. And the mitigations we are expecting now, every PFA should have a robust research department, very key, so that you know when to enter, when to get out, and you analyze the results of this company and know maybe what you saw yesterday, today. Since you need to take into consideration, PFAs must have robust research department to be able to analyze those results as they come out. So we need the financial health of those companies. And as we look at the valuation, how much price are you going to buy? So in that way, when you look at the financial health, you now look at what is the valuation saying? What price am I buying this stock? You look at the timing of the market too, so that you enter at the right time and you get value for your RSA holders.
Thank you very much, Chief Investment Officer, as well as General Manager, NLPC Pension, Modane Ekundayo Stephen. It's been a pleasure having you on the program.
Thank you so much. My pleasure having been on this program. Thank you.
Yeah.